Capital structure design. The capital structure is said to be optimum when the marginal real cost, both implicit and explicit, of each available source of finance is more or less similar. Whenever there exists optimum capital structure, the cost of capital is minimum and the market price of the share is maximum. The use of debt in capital structure of the firm has both beneficial effects as well as destructive effects. The beneficial effects may be that it is tax deductible and a relief in that direction is more than satisfactory, but its destructive effect is financial distress, which may cause the firm from relatively minor liquidity shortages to becoming bankrupt. It is hence accurately told that beyond a certain point of financial leverage, the expected cost of financial distress outweigh the tax benefits so obtained. Hence, if one is set to find the maximum share price of a firm, it is very difficult to gauge, but most certainly the capital structure can be so designed that an optimum capital structure results. Hence, even before a financial manager or analyst set forth designing an optimum capital structure, they have to find a way to design an appropriate capital structure as the first step. Hence, in that context, the key factors which will involve deciding an appropriate capital structure are: one, profitability aspect. Second is controls. Third is industry in terms of leverage ratio as well as nature. Fourth is consultation with lenders or investment bankers. Fifth is commercial strategy. Sixth is timing of a public issue. And seventh is company characteristics. We will examine each of them in detail. So first we'll take a look at the profitability aspects. First consideration for profitability is EBIT EPS ratio, which we have discussed earlier. EPS, as explained, shows the value of the firm in terms of earnings from one share at different levels of EBIT, or earnings before interest and tax. Another aspect is coverage ratio, which is given by this equation, which is here. EBIT divided by I plus SF by 1 minus T. So like EBIT EPS analysis, the coverage ratio can be found out for various levels of EBIT. So in terms of liquidity aspects, analysis of cash flow becomes important as it is the cash available to meet total payments, which is the cumulative charge of interest and principal, which needed to be met by the cash flow available in the fixed term. From a bird's point of view, it may be possible that EBIT of a company may be adequate to cover specific commitments arising out of debt, but if the firm may not be in a position to meet obligations because of the fact that its income is blocked owing to higher inventory, receivables, and sometimes in the middle of a purchase of fixed assets to keep up with its growing demands. In order to get a better perspective in such conditions, it is advisable to have cash flow analysis as an essential ingredient in the case of any sound capital structure decisions. Controls. One major criterion is control and the attitude shown by the management of a firm towards lenders as by law. The lenders cannot have oppressive controls on the management of a firm just because the firm has borrowed money from them. The lenders may, however, place restrictions in the loan agreement, but that is as far as it gets. The restrictions only with loan terms and not on the management of the firm. For all practical purposes, lenders exert minimum controls on the management. However, in the case of preference shares, if the amount to be given out as preference dividends is not given by the company because its financial story has deteriorated to a lower level and the preference dividends remains as dues even after a prolonged few number of years, which is 2 years in India, of this non-committal, the preference shareholders are given right to attend the meetings and exercises or are allowed to exercise voting rights. Yet, like other creditors, they do not have any say in the selection of management. The bottom line is the power to select the management of a company rests only with equity shareholders. And hence, if the main objective of the management is to maintain control, they will surely enjoy greater emphasis on the debt raised, as well as preference shares in addition to capital requirements, without sacrificing much of the management control that they must always wield on. However, in situations where the company borrows more money than what they can repay, the lenders or borrowers may seize the assets of the company in order to get satisfaction for the money so let out. At this juncture, the management may lose all the controls. Under such circumstances, equity financing may emerge out as the best option for the management so that they may not sacrifice the control, which is most important in placing the required control in a closely held firm. The management in a widely held firm do not need to worry about these aspects as the company is held by the general public and the shares are widely distributed. There is also the fact that in such companies, the shareholders are satisfied merely by receipt of dividend payments and have neither the time nor the wits to participate in the management of the firm or company. So that completes controls. Next is industry in terms of leverage ratio as well as nature. Depending upon the nature of industries, the capital structure decisions differ. For example, in the case of refrigeration industry, since the sales are subject to a wide fluctuating period due most for the annual and seasonal climatic variations, the firms have a low degree of financial leverage. For such firms, the operating leverage may be higher. In case if both the parameters are higher, the total risk of the firm or the combined leverage would be exorbitantly higher. Hence, in order while designing the capital structure, such firms should rely less on debt and should have or at least aim for a more conservative capital base. However, firms like public utility and services do not have a lot of intra-industry competition and hence can afford to have more debt in their capital structure. Next is consultation. By consultation with financial analysts and managers who have experience in handling securities which best fits an industrial firm, it's always better to take the opinion of such investment analysts, investment bankers, and lenders owed to their experience in this field. Also, the opinions of prospective lenders may be of greater importance to the firm as they are the ones who may provide funds to the firm. So their perspectives on this are most important as they may prefer to buy a certain class of securities and the information should be most useful to the financial manager and help him take a decision regarding the class of securities to be issued. Also, if the financial decisions may lead to valuation, the finance manager should think in a similar way to an investor in the same field. Next, it is commercial strategy. A company should in theory be able to show flexibility in terms of source of funds and the size of funds required, whether more or less in the same manner. This means the financial manager should be in a situation where he or she could change position. Therefore, while going forward with his design of a capital structure, he should not lose sight of a future urgency or impact on the present financial plan. For instance, the firm may adopt an aggressive debt plan, but in future may opt for an equity financing plan. In such a circumstance, the present financial plan should not be an unwise debt policy, forcing the firm to take on a huge debt with a future need to issue equity financing with an increased cost of equity situation. Hence, always the firm should operate under a maximum safe debt plan. A provision for unused debt capacity can be a good enough consideration for the firm or company whose demands may be sudden and erratic. So always keep in mind that for such circumstances, the company may take refuge in callable options and preference shares even though at a higher yield. The callable preference shares indicate to the company to repay principal when called upon by the lender. In such circumstance, the financial manager faces risk and return trade-off but should take caution not to overstep in matters at a highest fee of what remains higher the gains warranted by such a motion. Next one is the timing of a public issue. Timing of a public issue is most important in capital structure decisions. Public offers should be made at a time when adequate funds are available due to the state of economy as well as due to the ideal working conditions in capital structure. Also, important is the government policies on monetary, tax and fiscal policies. Higher debenture issues show a scarcity of debt capital and lower PE ratio, price to earnings ratio on shares are indicative of relatively unavailable equity issues. It's also always important the timing for if a finance manager has gone chasing behind cheap capital, whether debt or equity, and has also obtained it, but if its usefulness lie quite outside any legible means, the time and effort spent on the funds obtained go a waste. So remember, timing is everything unless the company cannot go on taking debt obligations due to a financial distress or something similar. The last one is company characteristics. Company characteristics depend a whole lot on the size of the firm. If the firm is a small company, it must normally rely on the owner's funds. But if it's a large corporation, some amount of flexibility can be had in the part of the corporation to choose its source of funds, whether debt capital or equity financing. So this completes the capital structure and all the fine points which we actually have explained. Thank you.